Hello, welcome back to Bullish Banter, where we explore the best ways to boost your income and achieve financial freedom. If you're new here, don't forget to hit that subscribe button and ring the bell so you never miss out on our latest tips and tricks. Ready to unlock your earning potential? Let's jump right in. Warren Buffett has garnered a large following over the years and is an example to be followed by many, including us. What we find most interesting about his investment approach, which has allowed him to earn 20% more each year since 1965, is that it's based on a few simple rules that anyone can follow. So we're going to break down these rules step by step with examples so you can apply them to your investments as well. First, Warren says that you shouldn't buy a stock unless you're willing to hold it for 10 years. This means you shouldn't buy stocks today, tomorrow, next week, or next month. If you're not ready to hold them for the long haul, you need to be prepared both financially and mentally to hold on to them no matter what happens in the market. Warren has always said that investing is more about psychology than intelligence, and part of that is focusing on the long term. Warren has a famous saying, "Don't own a company for 10 minutes if you're not willing to own it for 10 years." This mindset helps you avoid thinking of investing as a game and instead makes you focus on the real business you're buying into and its future. Giving great companies plenty of time to grow is exactly how Warren built his fortune. For example, some of the companies Warren has invested in are American Express, Coca-Cola, Bank of America, Visa, and Moody's. All of these are major investments in his portfolio, but he's held each one for more than 10 years. In fact, Buffett first bought shares of Coca-Cola in 1988 and spent around $1.3 billion in total. But today, thanks to time and the power of long-term investing, that investment is worth 24.8 billion yuan. Need to be confident in the company you're investing in and not worry. If its value drops temporarily, Warren mentions that there have been 3 times in Berkshire Hathaway's history when its stock price dropped by 50%, but he knew there was nothing wrong with Berkshire Hathaway and didn't worry about it. You need to have the right mindset and be willing to hold your investments for the long term. Buffett's second rule is simple: don't lose money. This means you should invest in companies that are undervalued, meaning their market price is lower than the company's true value. If you do this with several companies, your chances of making money in the long run increase because the market tends to correct this undervalue valuation, causing the stock price to rise, even if you get 6 out of 10. Investments, right? You can still have a good return. However, it's crucial to know how to handle the investments that don't work out if you realize you've made a mistake. It's important to acknowledge it quickly, limit your losses, and if necessary, sell the stock. Don't hold on to a losing investment, hoping it will recover, because that can lead to even greater losses. Buffett often says that if you're in a hole, the best thing to do is to stop digging. The key to reducing the risk of loss is ensuring that you're buying stocks of companies for less than what they're really worth. An example of this is when Buffett bought shares of a semiconductor company in Taiwan in the third quarter of 2022. He sold them shortly after in the fourth quarter of that year and in the first quarter of the following year, making a significant profit. This shows that he followed his own rule of not losing money by seizing a good opportunity and exiting at the right time. Buffett's third rule is to buy stocks for less than their intrinsic value before buying shares in a company. Ask yourself, how much money is this company going to make me in the future? This is more important than how much the stock is worth today. To determine this, you need to analyze the company's cash flows, which means looking at how much money is left after all expenses are paid. If the market price of the stock is below what you believe its true value is, then you found a good deal. Buffett uses a technique called discounted cash flow analysis to calculate a company's true value. This involves estimating how much money the company will generate in the future and how much you would be willing to pay for that money today. An example is when Buffett bought shares of Apple in 2016. At the time, Apple was already one of the most valuable companies in the world, but Buffett saw that Apple had a very strong competitive advantage and believed that the company would continue to generate a lot of money in the future. He bought the shares when they were cheap relative to the company's earnings, because he knew they would appreciate over time. And he was right, Apple became even more valuable. So if you're not sure that an investment will give you a good return, it's better not to buy it. And that brings us to Buffett's fourth rule: don't cling to businesses you don't understand. This philosophy is based on Buffett's belief that you should only invest in things you understand deeply. But what does it really mean to understand a business? In terms of investments, it's not just about knowing the specific details of how a product or service works, but about how that business will develop over the long term. Buffett looks for businesses whose prospects he can foresee over a 10 to 20 year horizon. An example Buffett often uses to illustrate this concept is the Wrigley chewing gum brand. Imagine you own a major gum company and produce popular brands like Double Minute or Juicy Fruit. Warren Buffett says that although he can't accurately predict the exact sales figures for gum, in the coming years, he is confident that gum will continue to be popular in the future. Why? Because he believes that the habit of chewing gum won't disappear in a decade or two. Current trends and technologies like the internet can change many things, but certain basic activities and products like chewing gum have long-term demand. It's not enough just to use stock evaluation tools or look at stock prices. Buffett points out that many investors, especially beginners, make a common mistake. They buy stocks without truly understanding the company behind them. This can become a problem when stock prices start to drop. Imagine you randomly buy shares in a company and soon after the stock price falls by 30%, you'll wonder if you made a good investment or if something important has changed within the company that you didn't notice or weren't informed about. The answer to this question can only be found if you have thoroughly researched and understood the business before investing. This means you don't need to be an expert in every aspect of investing, but it's crucial to recognize what you understand and what you don't. Staying within your circle of competence is vital. If you venture into businesses beyond your area of knowledge, it's only a matter of time before you lose money. Buffett's final investment rule is clear: seize golden opportunities when they arise in life. We're not presented with countless chances to make important decisions, and there are often life-changing opportunities in his more than 28 years of investing. Buffett highlights that he has found only about 3 truly exceptional opportunities in the stock market: the crash in 2000, the global financial crisis of 2008, and the stock market collapse in 2020. These exceptional opportunities come about once every decade, so it's crucial to be alert and mentally prepared to act when they arise. The key is in taking action. Buffett wants to convey that many people miss out on incredible opportunities in the stock market because they're too busy paying attention to rumors and news rather than spending time researching and making informed decisions. This causes them to miss valuable opportunities and fail to realize their potential. We hope you enjoyed the video. If so, please leave a comment. And the YouTube algorithm highly values that and will recommend our videos to more people. Give us a like and turn on notifications to stay updated with our latest content. Thank you for watching and see you in the next video. Thanks for watching, everyone. If you found these tips on making money online helpful, don't forget to give this video a thumbs up and subscribe to the channel for more awesome content.